Have you ever wondered how a booming economy can suddenly crash? Let's explore the events that led to the Japanese real estate bubble of the 1990s and its aftermath. In the 1980s, Japan's economy was on fire. Rapid industrial growth and technological advancements led to increased investment. The stock market surged, and so did real estate prices. Speculation ran rampant. Investors believed that property values would keep climbing. This led to a significant increase in loans from banks. The financial institutions fueled the hype, lending money to anyone wanting to invest in real estate. By the early 1990s, prices were inflated beyond reality. A plot of land in Tokyo's Ginza district was valued higher than all of California. The situation seemed unsustainable. Then, the bubble burst. In 1991, the Japanese government raised interest rates to control inflation. Suddenly, loans became more expensive. Investors, unable to repay their loans, began to sell off properties. As more properties hit the market, prices plummeted. The aftermath was catastrophic. The economy entered a recession known as the Lost Decade. Banks struggled with bad debts. Many financial institutions faced bankruptcy. Unemployment rates soared, and millions of people lost their homes. Lessons learned from this bubble are essential in today's economic climate. Understanding investor behavior and market forces can prevent similar situations in the future. In summary, Japan's real estate bubble was fueled by speculation and easy loans. Its burst led to widespread financial turmoil, leaving lasting effects on the economy. To learn more about the impact of economic bubbles, don't forget to like, subscribe, and share this video. Let's keep the conversation going.